No matter where you run, where you hide, inflation is here and it's crushing your growth stocks portfolio, and there's nothing you can do to tweak around it. Because look at the data, things are getting more expensive. So in this video, I want to show you how you can tweak your portfolio to make it a bit more defensive. Welcome back to Family Investment, and today I want to give you 5 stocks that I've been buying and I'm sharing with you today on how to make your portfolio more defensive and also more stable. So before I start my video, please give me an early thumbs up like, because I promise you this video will make it worthwhile for you. So let's start. What is inflation? Just keep it simple. Inflation. Price gets more expensive, the price of milk, the price of oil, the price of anything you buy that you need for stable, and then it gives you less money because your expenditure has gone up, less money for you to spend. And it affects the stocks because any inflation type affected stock, especially the growth high multiple, they get impacted. It's very hard for them to grow despite the fact that earnings goes up. I'm a growth stock portfolio investor, high concentration. I'm not willing to sacrifice any of my growth stocks because I bought in great value. Then again, we cannot keep buying the dip. We need to stabilize our portfolio. I'm trying to stabilize the portfolio and it's working. It's been working for the last 6 weeks. I'm sharing this with you. And this video is a partnership with stockcard.io, and I will be actively using stockcard.io to guide you through these 5 key stocks, because this graphical illustration chart will tell you 1,000 words to help you make that decision. And if you sign up to stockcard.io, you can get 10% off with my recommendation name below. So give it a try on the trial. If you like it, you can sign up. For me, I'm using the VIP one, and hence I'm getting all this full-blown data. Now for the very first stock, Louis Vuitton Moët Hennessy, LVMH, the French company. And guess what? Arnie Benoit, the #1 richest man in the world, has already surpassed Elon Musk and Jeff Bezos. Share price for LVMH keeps creeping up and up and up non-stop. I love the products, I love the company, and I think they are here to stay. TTM 7x multiple with a gross margin of 67%. Think about it, guys. A company that sells bags that need raw materials delivered from various parts of the world and need handmade craft are making gross margin of 67% profit. When the demand goes up, when they don't have enough supply, they will just rate hike the price and appreciate their goods. And guess what? People pay for it. And again, I'm going illustration on my right hand side here. The Louis Vuitton stockcard.io is telling me strong operation. Yes, strong operation, great management, great control of their goods, and most important, their branding. Outperforming the market regardless of what they do. They can control their price, they'll make sales, they've got reputation all across the world, especially in China, South Asia. Okay, outperforming the market still after so many decades. Fair growth potential? Agree, because it's an established company, it pays you dividend, and then after it says an overvalued stock. Yes, of course, it looks like an overvalued stock. Before COVID, they were worth around about $500 per share. Now they're over $700 and it's still going up. And guess what? We want to see the revenue next following quarters on how they sell with the opening trade, when people are traveling again and people want to spend money, and this is one of the places that people will spend money on. Now for stock number 2, and I like it, I've been Goldman Sachs. TTM of 7.5% and operating margin of 46%. They've been cutting costs. Interest rates will boost the revenue, and PEG ratio now of about 10%, revenue growth of 0.75, making it look really cheap. Despite the fact that the share price is breaking all-time high, but with the growth and the PE ratio and the great revenue run and the Q2 2021 earnings, is making it look attractive. That's what I'm buying. But now let's go to stockcard.io to see whether they agree with my point of view. And you will be surprised. We are getting the 4 horsemen. 4 horsemen meaning I get 4 ticks of great green thumbs up. Look, high growth potential, opening trade, strong operation, no doubt about it. One of the best people get employed in Goldman Sachs, outperforming the market and its peers, and also undervalued stock. I agree. When I did my calculation, I am close for Goldman Sachs to be double on where it is now. This is a stock to buy, and this is what you shouldn't miss. Defensive yet growing. Stock number 3, it got a bit battered. Bad earnings. Last year, COVID hit it, Brexit hit it. Yes, it's a British stock. I've mentioned it many times and I'm buying. London Stock Exchange, ticker LSEG. Gross margin, goodness sake, 89%. They just sell data, they just sell revenue based on IPOs, based on trading activity. Man, they're making money off thin air. Increasing trading activity post-Brexit looks promising. PG ratio now of 4.6 because of the low growth. Can I call out my friends at stockcard.io and tell me if they agree with me? 1. High growth potential. Yes, with the high growth margin, no doubt it's a high growth potential. Strong operation is one of the key indicators in London that makes money to keep the city generated revenue, to keep it going, to keep people employed. And also, same return as the market, so it's going steady just now, which is good. And we just want to see it turn it around, crank up the gear a bit. And finally, it says overvalued stock. I don't blame stockcard.io. The reason why this happens is because of the revenue that's dropped. It's looking really overvalued because the TTM has gone up. But if they do turn it around next year, what's going to happen? So I think with the drop this time at 80, where I've started buying at 75, I think it's a good time, good run to buy with slight dividend payout. So LSG is one of my favorite UK stocks just now. Number 4, Warren Buffett's Berkshire Hathaway. Earnings Q2 2021, the amount of money and the buyback. Despite the fact they have not bought another big company or took over anybody at great value, but this has got potential to grow. So for TTM of 2.4, very affordable, gross margin of 52%, even though they own the likes of Apple, Bank of America, Chevron, 140 billion cash waiting to deploy. And this includes their buyback of last quarter of 6 billion, this quarter of 6 billion. With interest rates, inflation also opening trade, it plays a favor to Berkshire Hathaway, the company. They have been yielding CAGR of 14 to 16% for the last 50 years. So they should be beating the index. Now they're below the index. So risk reward ratio is good. Stockcard.io, the chart as you can see, high growth potential, no doubt about it. Strong operation, no doubt about it. We like companies with strong operation. Underperformed the market. It's underperforming market. Yes, it's waiting for the recovery run because remember they own lots of oil, they own lots of banks, they own Apple. And when the interest rate comes out, when the opening trade, they will be in their favor. And also an undervalued stock. One of the biggest company in the world. It's called undervalued on stockcard.io. Doesn't that ring a bell to say buy me now, hold me, because it stabilizes your portfolio and I like it. And stock number 5. Okay, let me tell you, I am a simple father. I'm a simple man. I think things openly. And number 5, you'll be shocked. It's McDonald's. You're going like, oh, I've watched this video. The 5th stock you give me is McDonald's. But McDonald's is one of the most defensive stock, regardless of COVID, no COVID, people wants to eat McDonald's. McDonald's at a TTM of 10x, it looks expensive, but McDonald's has always been 10x for as long as I knew it. Gross margin of 53%. Inflation-proof stocks. Okay, everything goes up in price. The only place you can afford to eat is where? McDonald's. Regardless of what background you come from, what diet platform you are on, McDonald's will be a PG ratio of 3.5. Again, let's bring my friends from stockcard.io and see what they agree or disagree with me. So fair growth potential, yeah, I don't expect them to be super high growth potential because they're not a tech company, but they are a good digital transformation. Strong operation, again, that's key in these aspects. Same return as the market, fine. As long as the same return and not underperforming, I'm happy because they need to keep the consistency regardless of the situation that's going on. And fairly priced stock. So it's not undervalued, it's not over, it's fairly priced. So it's one of those, I rather own McDonald's stocks and own cash at hand. If you hold cash, you're going to get killed by inflation of the 4 to 5%. I rather hold McDonald's stock because they pay me with 2% dividend. If they go up, yes, win-win situation. So most likely owning McDonald's is way better than owning cash. That's why it's at my number 5. Okay, the next thing is I've got 2 more stocks, but I'm sharing exclusively on my Patreon member. So there's 2 more stocks. If you are a Patreon member, go to the Patreon channel. There will be a special link for the additional stock number 6 and number 7. And thank you all patrons for supporting me. And I hope these 2 additional stock will blow you away on why I chose that. All I can say is thank you very much for watching. And one thing I would like to add is if you want to join my free course, Buy Trigger, which is one of my signature trademark, I'm sharing that with you on Thursday, tomorrow, 5:30 at Live Spot. So check the link below. But if you miss Live Spot or you watch this video later, I will be on Live Spot every Thursday, 5:30 UK time, giving guidance and teaching that I can do. And best of all, I bring you up on stage and we interact, we discuss while the other audience listening. So it's nice, compact, and we can share and learn over the hour or 2 as long as you keep engaged from by me, and I will help you guide through your investment journey. Otherwise, thank you, have a good day, and goodbye.
We our family investments channel. We focus on saving, investing, and growing your wealth so you can spend more time with your kids.
My daddy worked very hard for this video, so please like and subscribe. Ding dong!
Enjoy the